Hello, everyone. Welcome to the Virtual Investor. Today, I have Daren Blomquist with me. He's from auction.com. And I don't think your title has changed, right? You are the VP of macro and microeconomic forecasting there, correct? More
That's
or
right.
less.
Yeah. Vice President of Market Economics, VP of Market Economics.
Perfect. And you came originally from Adam before that, right? Data
That's right.
management years ago before that. How has your transition been? How much do you like working for auction.com?
I really like it. It's been, I've been here 5 years, which is kind of incredible to think that it's been that long because it feels like just yesterday that I started. But you have the first year transition where you're learning. I was in the same industry, but every company has its different culture and different way of talking about things, different lexicon. So that took, I would say it took about a year to really hit my stride, but it's been great. I mean, we wish the business was, the business was doing better, and at no fault of our own. I would say it's more of the market conditions just have been constraining the total addressable market that we that we're looking at, that we're part of. But aside from that, the actual job that I get to do in terms of looking at both macro data as well as our own. I mean, we have such rich marketplace data. I guess you call it micro data within auction.com, that it's been eye-opening for me to be able to play around with that and draw out insights for our own business as well as for the marketplace.
Yeah, it's been like for the auctions, and of course, I buy on online auctions, been doing that for a long time. But it's been an incredible journey if you think about it, from that financial crisis in 2008 to record levels of inventory as far as foreclosures, to now probably near record low levels of inventory from the pandemic, right? From what went on there, then record low rates, keeping it low. So with that being said, where do you think we're heading? I know there's been a slow, steady stream of foreclosures. I still follow Adam. I'm sure you're still right up on top of all that data too. I don't see anything major hitting there. What do you foresee in a foreclosures outlook, say for the next year, and then even beyond that, up to the next 5 years? If you could forecast out that far, it's difficult, I know.
Yeah. I mean, that's actually one of my jobs, is to create a long range forecast that goes out 5 years. I mean, once you hit 5 years, it's really just, I mean, I hate to say this, but it's anybody's guess
So true.
in some ways. So you have to hold that loosely. But it's valuable just to, and we tend to create scenarios like any, I think most economists will operate this way. Well, especially going long range is, here's what things would look like if given a recession and more severe home price correction, versus here's what things would look like if we just can continue kind of at the status quo. So, I mean, if you want to share my slides,
Oh
there,
yeah.
I can get to that question and show where we've been. And this is actually Adam data. So, as you mentioned, looking at foreclosure starts, which is kind of the top, not quite the top of the funnel for the distress market. But if you look at the graph, this is the same data, but just zoomed in on the left and zoomed out on the right. And on the left, you see we have come back. I mean, we bottomed out with foreclosure starts during the pandemic in 2020, with less than, or around 20,000, less than 20,000 per quarter foreclosure starts nationwide. Just in the first quarter of 2020, we were 80,000, 81,000. We've climbed back. So we are steadily seeing the distress market come back, but very slowly. We're still at about 80% of pre-pandemic levels there with the 68,000. And then when you zoom out, that really puts it in perspective in terms of where we are compared to the 2008 crisis.
Right.
For sure, we are, we're at a fraction of those levels. We were seeing more than 500,000 foreclosure starts per quarter in some of the worst quarters back in 2008. So that's where we've come. But to answer your question about where we're going, I think we don't see this line like spiking up. The most likely scenario is not that we'll see this line spiking up. And it's hard to imagine, even with a pretty severe home price correction, when we put that in our model, we see this line spiking up to maybe about half the levels that we were seeing in 2008 or less. And so even in a more adverse, stressed scenario, we don't see this coming back. And I think a lot of that has to do with the quality of loans being originated in recent years. Now, there's slowly but surely been some deterioration of the quality of loans in terms of debt to income ratios and things like that. But generally speaking, they're much more solid than what we were seeing in 2004, 5, 6, right before leading up to 2008. And then the second reason is the supply constraint that we've talked about, I think, and many people talk about, in terms of over the last decade, how the housing supply created has been at a constant deficit to the number of households that are being created. And so that's going to keep, even if you did have a stressed scenario in the housing market, it would keep the distressed market in check, because you just have that lack of supply as kind of a floor for the market.
No, I would totally agree. I mean, you go back to that financial crisis, 2008, what led up to that. And I started investing at the end of 2001. So it was kind of in the lead up going into that, saw what was going on when anybody can get a mortgage, no income verification, no job verification, right? As long as you had a half decent credit score, you were okay. You got a mortgage, 90%, some 100%. Some of the programs I saw out there, I remember talking to other investors, were like, this can't end well. It's a ticking time bomb. And the question is, what's the trigger? What was to trigger the time bomb? Of course, Lehman Brothers was the one that was the trigger there when that collapsed. And then everything really started to fall apart. But even before Lehman collapsing, the market, you started to see the market correct really at the end of 2006-07 timeframe. It really started to correct. And then you had that big inventory there. Now we just don't have the same factors coming into play, as you've said so many times here, for sure.
Yeah, I mean, and actually, I think these foreclosure starts will be a leading indicator. You can see back in 2006, the home prices didn't really start falling until, depending on whose data you look at, around at least 2007.
Yeah.
But we were starting to see these foreclosure starts ramp up pretty quickly in even late 2006 there. And so that, if you start to see that happening, and speaking of that, I mean, I think there is some localized stress maybe happening more than others. And so if you look at this is the foreclosure starts by market, and looking at the year over year change is the color. So the orange is a bigger year over year change. The blue is a decrease in foreclosure starts. And then the size of the circle is just the volume of foreclosure starts. So a place like Chicago, their big circle there, you do have a lot of, quite relatively speaking, a lot of foreclosure volume there, but it's actually foreclosure starts are coming down, at least in March. Whereas in, I think some of those orange dots in Florida are bigger, and with seeing some increases in foreclosure starts there, which is some sign of stress in those markets. Now, I mean, this is 1 month. You have to look at it over time, but that's, a quick look. I mean, one of the things that stood out to me, when I created this map, I was also looking at a lot of maps having to do with heat maps that I didn't create, but having to do with rising insurance costs. And I saw a lot of the same patterns in Texas, California, Florida, with those rising insurance costs along with rising foreclosure starts.
Yeah.
So it's
hand in hand.
So some signs of stress. I mean, I know that you have a lot of insight into the markets, and one of the things you look at, I think, is inventory, right? Where's inventory rising? And I don't think I have it in this deck, but we do look at, actually, I think in part because of what you said you look at, I've started looking more at the inventory on the multiple listing service. And seeing some rises in Florida there as well.
Oh, for sure. And in particular markets like Cape Coral, and then you have it in Sarasota County. And I think what Cape Coral, you got to keep in mind with an area like Cape Coral and Port Charlotte, North Port Charlotte, those areas, those are blue collar working class retiree spots. So we're talking about a lot of people that are living on Social Security and a fixed income, right? A smaller fixed income. And when you look at when Hurricane Ian hit 2.5 years ago, I think it was around 2.5 years ago, somewhere in that range, they changed the flood maps. So the flood maps were completely redrawn, the FEMA flood maps I'm speaking of. And I saw people's rates go from $500 or $1,000 or $1,200 to $10, $12, $15,000.
That's amazing.
These people can't afford it, right? You can't.
Yeah.
So they have to get rid of these properties. And that's why you see such a glut of inventory in certain areas. And then properties that are not in that FEMA flood zone, they sell like that, right? Because people know they don't have those additional costs. So I think it's kind of pushed some people inland further, out of the flood zones and out of the wind insurance. And, because you had regular old car insurance and homeowners insurance double and triple in some cases as well. So those are some of the micro factors that go in and push and cause this increase in inventory, probably in Texas, probably in Southern California as well.
Mm-hmm. Yeah. And I think property taxes are another piece of the puzzle there.
Big time.
That are, those, what I would call hidden costs of homeownership. You know what your mortgage is going to be. Most people are getting a fixed rate mortgage these days. It's going to be for the life of the loan. But what you may not know is those variable costs of insurance and property taxes. So that's, I think, a stressor. Again, in the context of we don't really foresee a huge wave of foreclosure starts coming, but there is distress emerging, and especially in certain markets. I do fundamentally believe that home prices are above what they should be given, historic price to income ratios.
Yes.
However, there's not, as you mentioned earlier, there's nothing that it's hard to point to something systemic throughout the entire market and throughout the entire country that would be the trigger, the catalyst, like a Lehman Brothers to cause those home prices to correct, violently as they did. But that I do think that there is a potential there because we're out of whack with the fundamental price to income ratios that we typically would see, that affordability piece.
Yeah, and we're seeing the affordability problem in rentals as well, right? I mean, it goes hand in hand with the housing when rents are rising, when the interest rates seem to be higher because people then go to rent because they can't afford to buy, and then interest rates drop. Those renters become homeowners if they drop enough, and then you'll see rental demand fall and rental prices fall. They kind of go hand in hand, mostly with the interest rate. And you have a lot of people sitting on the sideline waiting for interest rates to drop, which they did about a week and a half, 2 weeks ago, we got a nice drop there. But really, I think what people are waiting for is the Federal Reserve to reduce rates. And I think what that'll do, I mean, that's going to be a positive for some things and a negative for most people out there. Most of the blue collar working class people, or just working class people, period, that are already struggling, because it's going to put more money into risk on assets such as stock market, bonds, cryptos, and real estate if interest rates drop, and then push pricing back up again. And there's really, I think we're at the peak of where pricing can be for homeowner affordability. And I'm sure you see that in the data.
Yeah, absolutely. I think, I mean, I'm almost afraid to say it out loud, but I think one of the best things for the housing market could be at least a modest price correction, or just prices kind of stagnating for a little while. And I almost, you see, maybe if you try to read between the lines of some of what Jerome Powell is saying and the Fed is saying, is that they're willing to leave those rates higher for longer to, and the housing market is one piece of this stubborn inflation that they're targeting with those higher for longer rates. And they wouldn't be mad at a price adjustment in in the real estate market. And we saw a little bit of a price adjustment, I think, at least in some markets back in, I think it was late 2022, early 23. Places, the most obvious example being like an Austin, Texas, or a San Francisco. We did see price adjustments there. But it's this interesting. These super low interest rates for so long have kind of painted, I think, the Fed in a corner to a certain extent, and it's tough to get out of that without causing some unintended consequences. I did want to show. So even though we're seeing foreclosure starts going up, this is our data from auction.com, and the percentages are just benchmarking to the first quarter of 2020 as kind of, maybe that's a normal foreclosure REO market.
Mm-hmm.
And then the green line is our foreclosure auction volume relative to that benchmark. So we're kind of plateauing around 49, around 50 to 60% of that level over the last really couple of years. And an REO auction volume is plateauing at around 30 to 40% of pre-pandemic levels. And so even though foreclosure starts, I mentioned earlier, are close to 80% of pre-pandemic levels now, the percentage of foreclosure starts making it to actual auction is much lower, which is now bringing down the overall volumes that actually make it to the distressed auctions. So there's volume out there. It's not gone away completely, but it's a new reality, I think, at least for the foreseeable, maybe not the foreseeable future, but for at least the near term, that we would see kind of these lower volumes. And it kind of parallels the retail market in terms of just low supply.
Yeah. Yeah, no, that absolutely does. And I think you'll see that a lot of these don't get to foreclosure because right now, one of the big things that educators, real estate investment educators, are pushing is going after the pre-foreclosures. So that may be keeping them a little bit artificially down. And there's good reason for it, right? I mean, this is something I've thought about targeting as well, because a lot of these people have 3-4% interest rates. Mm-hmm. So if you're able to pick up that property subject to keeping the existing financing in place and giving them some walkaway money, you are way ahead of the game, even if you're paying more now because your interest rate's so much lower as far as a monthly payment than you are letting it go to foreclosure and picking it up, say $50,000 or $75,000 cheaper, depending on what that total purchase price is. So that's why you're seeing, I think, some of that should continue too. Mm-hmm. And it does make sense, but some are just going to go through. I played that pre-foreclosure game back in the day. And most people that are going into foreclosure, I find, are going into foreclosure for a reason. They kind of go away and don't want to talk and deal with anybody. They're dealing with different things in their life, and they usually don't want to do stuff. Some small percentage of people do, but so it's something I think you won't see it take a dramatic decline, but you'll see it be a little bit lower than maybe normal.
What be a little bit lower?
I think the getting to foreclosure, getting to the REO step, right, where it goes through the sheriff's sale or it goes to the courthouse steps, depending on the state, which one you go through here. So I think you'll see some of that lower, but the REOs, I think, will definitely trend higher, period, overall, just because I think that's just the way they're going to trend. And especially over the last 2 years, you have a lot of people with 6, 7 plus, maybe even 8% mortgage rates. And if rates drop back down, they don't mind walking away from that potentially, some people. So I do think we'll trend upward. It's just not going to be big, like you said. It's just going to be a chop and maybe a little bit up here and there. And it's different market.
Yeah, I agree. One of the reasons the REO market is lower as a percentage is we are seeing higher sales rate at foreclosure auction because of this low supply. You have more people when it goes to foreclosure auction. It can either sell to an investor like yourself, or it can go back to the bank as an REO. And we're seeing there's been a shift. Prior to the pandemic, it was about 35 to 40% of those properties would sell at foreclosure auction, and then the remaining 60 to 65% would go REO. Now we're seeing a flip. It's more like 50 to 60% are selling. And so then you have, 40 to 50% going REO. So a a lower pull-through rate to REO. But that said, I think, it's interesting that you said we're looking a lot at the recent vintages of loans that have been originated over the last few years near the peak of the market, and I guess with the higher interest rates. And your point was these folks would be a little bit more susceptible to walking away. Is that right? Is that what you're saying?
That's kind of one of my thoughts, because it costs so much more, especially if they can go rent cheaper potentially, and don't know if they'll be able to, right? Because
Right.
rents haven't really come down,
and they can't, their options are also more limited
yeah.
to somehow bring down their mortgage payment if they're struggling to pay it.
Yeah.
Because it's hard to find a lower a lower mortgage rate out there to refinance. So that I agree with that. I mean, here's where we see that volume playing out by state. So this is specifically the foreclosure auction volume, but you would see this pattern probably very similar with the REO auction volume.
Mm-hmm.
The green being areas where we're seeing that come back more quickly to those pre-pandemic or so-called normal levels, and the blue being where they're still well below, in many cases well below. Florida stands out for sure. 26% of pre-pandemic levels. So 74% below pre-pandemic levels. I think there's a combination of things going on in Florida, but that's low. But you see other markets where we're at, over 100% of pre-pandemic levels. Those tend to be lower volume markets, but you have, places like Indiana, Oklahoma, that you're seeing over 100% of pre-pandemic levels. So there's more opportunity in some states than others in terms of at least volume.
Yeah. No, I mean, this is great. This is leading indicators here. It's the ones I'm really looking at as to where you're going to see the inventory down the road here, 6 months, a year, or 2 years down the road, right? Where this is just the start of it.
But yeah, I think, with some of the higher volume states like Florida and even Texas for 45%, which is a little bit on the low side. And then certainly it's hard to see there, but New York and New Jersey are in that category too.
Yeah.
But they're higher volume states. So I'm a little wondering there if this represents just more because of the high equity there, more people are avoiding foreclosure than was the case back, prior to the pandemic, or if there's more pent up foreclosures there that are just being held back by some of these programs. And that, those pent up foreclosures will be coming out in the next couple of years. I don't know for sure if I know the answer to that, but I think it's probably a little bit of both that's going on in those states.
I would totally agree with you. Yeah, I would definitely agree. I mean, you look at Florida, that's where you still get 1,000 new residents per day. So you're adding a lot of people in here. There's still some demand. I think New Jersey really took a huge pickup from people moving from New York out of the city, out of Manhattan, and it's still going. And there's not much inventory in New Jersey. And even from people, even Connecticut, going to like New Jersey and Delaware. Carolina's got a nice boost from that. Although I'm seeing South Carolina there on your map, it's really boosting, getting closer to pre-pandemic levels of 72%. It's interesting that Texas is only at 45%. Yeah.
Yeah. That's interesting to me too. I did want to, I had a slide here. Let's see. We could talk about this briefly, but this is just kind of the distress market, the way we look at it, from delinquency all the way down to foreclosures brought to auction. And the point here is that we actually have seen short-term delinquencies now higher than they were back in 2019.
Oh, wow.
At the top of the funnel there, the green is the 2 million. This is according to Mortgage Bankers Association data. But then if you go down the funnel further, it's for all other categories, as you become more seriously delinquent, you still see higher levels or lower levels now than you were back in 2019.
Yeah.
So
so it's the short term you're seeing right now, right? It's really the increase is the short term, not the 90 plus day. You're seeing a 30-day really start to increase right now.
Yeah, and but that's been going on for the last year or two. If you look at the
Okay.
MBA data, and it seems like those folks are not making it down the funnel, or
Gotcha.
more of them are not making it down the funnel. I do think it has to do with high equity, has to do with more government programs that are helping these folks out. We asked, I thought this would be interesting to you. We had a conference of about a month ago where we brought in our clients who are the mortgage servicers, banks, and all that. We had a survey. This is one of the questions we asked, like, what percent of your organization's loan and loss mitigation do you expect will permanently perform? So this is getting to my thought about how many of these loans that are caught up in one of these programs designed to prevent foreclosure, like there's partial claim, there's loan modification, those sorts of things. How many of those will stick for the long term? And our clients, and this was actually a little bit lower than I expected. 51% said that, or they expect 51% of those to actually in the long term perform.
That's interesting.
So about half. Right now, if you look at the MBA numbers, it's about 72% are performing for the long term of the loans that went into forbearance during the pandemic. So our clients at least are expecting, the longer we go, some of these folks will just reach the end of their rope, unfortunately for them. So that's interesting. The one thing I wanted to point out about some of these states, these are one of the things that's helped homeowners out a lot in terms of avoiding foreclosure is the Homeowners Assistance Fund. $10 billion allocated by one of the congressional laws that was passed during the pandemic. Right now, about 80% of that $10 billion nationwide has been spent, but in some states, a lot more has been spent that's allocated to those states. So for instance, in Florida, 97% of the funds for Florida have now been used up. So we may see a change there with Florida as homeowners. There's no more homeowners assistance fund to dip into there. That's one piece of the puzzle. And then I know I'm going all over the place here, so feel free to direct me if you have something you want to talk about. But this actually gets to something you said earlier, because we're really watching this idea of pre-foreclosure sales quite a bit as well that you mentioned. And we are, if you look at pre-foreclosure sales and then combine it with foreclosure sales and REO sales as a total market, a total distress market, the pre-foreclosure sales are now a much bigger share of that market. Now, the pie has shrunk. Overall pie has shrunk. If we had actual numbers here as opposed to percentages, you would see those bars on the right much lower. But as a percentage of this total market, pre-foreclosure sales are now like almost 2/3 of the market, whereas they were closer to 1/3 back in 2019.
That makes sense, though. You know what, Daren? Because if you go back, the reason pre-foreclosures were so difficult after the financial crisis, because there was no equity, right?
Yes.
Equity was immediately erased. Right now, we still have equity. If you had a correction, I think that pre-foreclosure would definitely dramatically drop. But it's people have equity, so they have the ability. All right, I'm behind, I'm screwed. I just got to sell this thing and get whatever I can out of it. So I think that's playing. Would you agree that that's?
Oh, absolutely. Yeah, and these are mostly equity sales. They're not short sales. It makes it easier for them to sell. And I really, I hadn't thought too much about the scenario you talked about earlier, where there's this combination of an assumable loan and a homeowner with equity who's struggling to make their payments. But that can be very appealing to an investor. To come in, and and a lot of these folks would have the FHA loans that are assumable. I would suspect. So you could take over that loan, and I am hearing more out there on the servicer side, the mortgage servicer side, that the assumptions are starting to gain some traction. I haven't seen any actual data on it yet, but hearing anecdotally that those are starting to gain traction. But really, I think to me, the puzzling part of this is it becomes, from maybe your perspective as an investor, the dealing with convincing that homeowner that this is the best decision for them to sell, to me becomes a very difficult situation. It's much different than going to an auction, especially going to an online auction and, clicking buttons to bid on property. It's a whole different game. And tell me if I'm wrong in terms of dealing with those homeowners.
No, you're dead on. It is a totally different ball game. Homeowners generally don't like to go into that auction process for the most part, and even still, a big percentage of investors out there don't want to. Partly because they're so busy with the direct marketing right to homeowners that they just don't have time to necessarily focus on this. So we have a couple of some of our students are big wholesalers that just added this as another arm. They work in these certain counties and they want to pick up any additional inventory they can. So they still look at and use the online auctions. I'm sure you've probably gained over the last 5 years or so, or 10 years, a heck of a lot more investors on your platform buying, for sure.
Yeah. But we're not listing. We don't have these pre-foreclosures on our platform.
No, you don't have that.
So, that's.
You have links though, right? So if people want to go to the auction steps and do it, you guys have links where they can go ahead and do that. So you're resourced that way. It's just you're not directly bidding there unless the state allows you to somehow. Usually you're going to a third party.
Well, it depends. It's about half and half. The states, we're actually crying the auctions ourselves, the foreclosure auctions. Now, most of those auctions are in person still. So again, talking about the foreclosure auctions as opposed to the REO auctions, which, as you know, are online. But the foreclosure auctions, about half of the states, we're able to cry those ourselves. So we have control of the auction, which we believe, I'm of course biased but I think if you go objectively to these auctions, you'll find the ones that are cried by the auction.com folks are objectively much better. And you actually know the auction is happening. We have people there that can answer questions, help you out. We try to make it a good experience. The reason we have to do it in person in a lot of areas is because state laws require that. Ohio is one state, and Florida actually is another state where they do have online foreclosure auctions. The problem with Florida is it's an auction that's on the county website. So again, we believe it's not as user friendly as our auctions.
Agreed.
So if you go to Ohio, we actually are conducting the auction on our website, which we believe is a better experience. And we've also introduced this idea of remote bid. So even if the auction is in person in many states, as long as we're crying the auction, we allow people to come in on their mobile phones remotely and bid, even if they're not there physically at the auction. So that's a technology we've introduced in the last few years that has caught on, and we believe is the future of this is that we're going to see more people bidding remotely. Actually, the old guard, some of the folks who have been doing the auctions for decades, have been somewhat resistant to remote bid.
Yeah, they want to control
investors who, because it's a little bit disruptive. You can't. I had one guy tell me, I don't trust, because the way that they hear that the remote bid is coming in is our auctioneer is saying, okay, we have a remote bid that came in for $1,000 more, and the guys there at the auction are like, we can't see this person, we don't trust it. But they're slowly coming to realize these are real bidders who are bidding remotely, and it does, of course, create more competition. So but ultimately we believe, the transparency is best for the market.
I would agree. And, I think this is the way things are going. I think more and more are going to be going online and through your website. through other websites too. It just makes sense. I mean, because logistically, if I want to bid on a property up in Pennsylvania where I don't live anymore, I have to go there. That's a pain in the butt to go to whoever many they have, once a month, or, for the different auctions, they'll have them once or twice a year. So yeah, I'd much rather just go through your site and be able to do it, right? Especially if I have proof of funds, can proof that we are able to purchase the property. I think it makes sense. I think more and more of these counties will come to that conclusion. It just takes time, I'm sure.
Yeah, actually, Pennsylvania is one state where we're working with we have folks who are talking to legislators there about trying to make it look like a little bit more like Ohio.
Mm-hmm.
So we'll see. But yeah, it's a hard road to hoe, because you have laws that were written 150 years ago, in the days of horses and buggies.
Yes.
And there's not necessarily a huge political advantage for them making foreclosure auctions easier.
Mm-hmm.
Now, on a kind of a related note, we do see states diving into the foreclosure auctions to try to make it easier for owner occupants and nonprofits to buy at foreclosure auction, which is interesting. And REO auction. You may have noticed that the first look
Yep.
stuff.
Program. Yeah.
How is that? I'd be curious to know how has that impacted what you and your students do in terms of the first look, which we can explain it to your listeners if you don't think they know what that is.
Yeah, so the first look is open to only owner occupants for the first, I believe, is it 30 days, Daren, or is it 50?
30 days, yeah.
30 days, yeah.
I think, 30 days.
Fannie Mae always had that. Freddie Mac had that. HUD always had that. But with the HUD CWCOTs, which is a different animal, that's where they started instituting it. Was it the end of last year, somewhere last year?
It was the end of 2022, actually.
2022. Okay, so it's been a while. But yeah, I think the ones that get affected mostly by that, Daren, are the ones that are in really good shape, right? That are like almost move-in ready, which there aren't a ton of that are foreclosures that are like that. So I don't know. I'm sure it's had an impact, but I don't know if it's had a big impact because they still don't let people into the property. So there's not many owner occupants I know that are going to want to go buy a property sight unseen.
Yeah,
there's not that many,
we've definitely seen a lift. It's not dramatic, but depending on how you look at it, it's like a 4-point lift in the percentage that are going to owner occupants. But it's going from like 6 to 9% or something in that range. The Urban Institute actually did a analysis of our data because they're very much, concerned with trying to get more of these into the hands of owner occupants. But they acknowledge exactly what you said, is that because of the barriers in terms of inspections and financing, a lot of these are just not appropriate for owner occupants off the bat. But I think it's having some positive impact. I've actually talked to some owner occupants who've purchased off our platform and live in the homes. But it is probably more of a subset, as you say, of properties that are in better condition and are a little more safe. And to be honest, I think investors like yourself are, for some of these highly distressed properties, are a necessary and good component of the ecosystem.
Yeah.
Because you put an owner occupant in one of those properties, they're going to be way over their heads and could end up losing the property even because of all the renovation that may be needed and all the unexpected components that they may not even know about.
Yeah, so true. A lot of the politicians try to paint real estate investors as bad guys, and it's just real. I mean, there was always a few bad in everything, right? But most people are out there doing good, buying these properties, renovating them, and then reselling them to an owner occupant. I mean, almost all the ones we sell anymore to owner occupants. We still sell some occasionally to buy and hold people or to investors to flip. But for the most part, we're selling ours to owner occupants. So they should be happy that we're doing what we're doing because they can't do it as well. And, it's not
Yeah.
the government. They shouldn't be involved in that. They should just be handing that off to investors to take care of and help make in a lot of cases, they've turned bad areas into much better areas because there's so many more owner occupied people in there who care about their house and don't want a bunch of tenants in there ruining everything. Right. So a lot of areas have improved dramatically because of that.
Yeah, absolutely. And I'd actually say, Paul, if you have any stories about, that you're either through properties you bought yourself or students you worked with, I'd love to have those, because one, I was mentioning in our client meeting a month ago, and one of the things we did, we actually brought in 3 of our buyers who were buying off our platform, like yourself, and had them tell their stories. And they're very, they're compelling stories about how they're going into these neighborhoods and actually improving them.
Yeah.
And actually our clients also realize that there's a portion of these, it's good to, if you can, to sell to owner occupants, but it's also a good thing for a lot of these communities is to have quality, affordable rentals.
Yeah.
So they understand that part of it too. But that was one of the most popular pieces of our conference, was just getting those buyers up on stage and having them tell their stories to our mortgage, the big banks out there, the government agencies. FHA was there, Fannie, Freddie, and they were all captivated by these stories. So I think it's important to be, we're trying to tell those out in the market, and love to have more of those. But it is still, it's hard to get that all the way up to the politicians who, it's so much easier for a politician to cast the investor as a villain and the nonprofits as the savior, which I don't think is always the case.
So true. And I'll give you 2 examples. I might even have sent you an email about this probably in the past year or so, of examples of areas that have been improved. So one year where I used to live in the suburbs of Philadelphia, a little town called Ambler, when I first started investing there in 2003, and we worked together with the borough of Ambler, which was trying to clean up their downtown, right? Their downtown had a bunch of commercial properties closed down, didn't have many restaurants, or it just wasn't that much there. So they were trying to make sure, and a lot of the properties in the area had become decayed, started at a lot of fires, a lot of damage. And so investors like myself came in there, bought these properties, fixed them up, sold them to owner occupants, and a bunch of us did. And I did many in that market. And the downtown area started filling up with restaurants and different stores. Now you know it. It's one of the real bright spots in the suburbs. And then Lansdale, where I was born and raised, which is only about 20 minutes from there, saw what happened with Ambler, did the exact same thing. And I've done a bunch of flips in the Lansdale market as well. Same thing happened there, and it's continuing. And they've had a lot of building and a lot of commercial businesses and everything moving into those markets there. So those are 2 examples of how basically the government works hand in hand with investors. They make things a little easier on the investors and simplify the permitting process, and don't make it so difficult. They come out quicker for inspection. So things like that, when you're working hand in hand with a local government, it's much easier with the local government, right, than the state or federal per se.
Yeah, that's really interesting. I'd love to hear more about those stories.
Yeah, we need more of that kind of stuff. I'm sure there's lots more all over the country that's happened with.
Yeah. So I don't know how much time we have, but I think we have, at the most 10 minutes, but we did ask our clients what they think is the highest risk of causing higher delinquencies going forward between now and the end of 2024. We gave them 100 points of risk and said, how much would you assign to each of these categories? And they gave 37% of their risk points to rising insurance and property taxes, which we've already talked about, then consumer debt delinquency. So we are seeing, this is the credit card debt, the auto loan debt, not just the debt, but the delinquencies are going up.
They're both at big time highs right now, both the autos and the credit cards. Yeah.
Yeah. So, and it's interesting. I mean, some of the traditional economic pieces, they're not as concerned with as high risk, like rising unemployment, falling home prices. Commercial mortgage defaults was down on the list too. That we are seeing more defaults happen there that some people believe could ripple out to the residential market.
That could be like that actually should be one of the tops, because what'll happen is a lot of regional and local banks will get damaged slash wiped out, where the government's going to have to come back into, or what is it? The FDIC will come over and take control of them and sell the assets off, and either a Chase or Bank of America or Wells Fargo will likely be one of the ones taking them over. And that could have big ripple effects in the market with a lot of these different things, especially with unemployment. I mean, I just don't see it being like a 2008 financial crisis. I don't think we have all the pieces in play to do that, but I definitely think there's a correction coming. I just don't know how big it is. What are your thoughts on that as far as a potential correction?
Yeah, I think the most likely scenario in my mind is more of this stagnating market over the next couple of years, which it's hard to say that because it's not a typical way the market behaves. But I think that maybe it's a little bit of wishful thinking, but I think that would kind of be the best outcome as well.
Agreed.
Is if we just saw home price appreciation really flatten out for a few years, allow incomes to catch up, and you see that affordability come back into place. I think combined with that, you'd have to see the builders continue to build, create that housing supply, and more supply coming. I think there is some pent up supply. It's hard to quantify this from aging baby boomers and others who've been holding out and just at some point, okay, we need to sell this property, and so I think some of that will ease the pressure on the supply side. But yeah, I think most likely scenario is kind of the stagnating home price appreciation, not a major correction over the next few years.
I concur 100% with that. I see it really chopping sideways, which is kind of what it's done this year so far, right? In most markets, chop sideways, a couple markets up a little, a couple markets down a little. But yeah, I think that's where we're heading, unless there's some dramatic increase in interest rates, which I don't think will happen, although you never know. But you never know what happens with escalation of wars like, Russia, Ukraine, the Middle East, and all that kind of uncertainty that goes on. So there are other factors that could come into play, especially with the commercial mortgage, that whole potential crisis could be a factor too. But the commercial one won't affect residential as much, at least initially. It might be a little bit further down the road with appetite.
But the bank failures is the piece that could ripple out, to your point.
Yeah.
Our clients don't think that there's going to be a huge increase either in foreclosure volume. That is, and so most of them, that big bar in the middle is, most of them are saying that there's going to be a 1% to 4% increase in their portfolios foreclosure volumes over, basically the next 6 months. So, that's kind of boring, but
very interesting. It's all good data. None of it's boring, Daren. I mean, you and I probably geek out on this stuff, but I think it's just good for people to really know this data because it drives what you should look at for the future.
Yeah. I mean, I think it's very interesting data. I just think it's a boring, it may be boring news for people out there. Like, oh yeah, there's not going to be a huge change. At least our servicers our clients who are the servicers don't see that happening. I wanted to end on, some of what our data is indicating, which is really people like yourself, Paul, who are bidding. I kind of aggregate up one metric, which I think is a very key metric from our bidding, which is the winning bid as a percentage of the after repair value of the property.
Yes.
And so that's the green line. And it was pretty consistent. I don't have this back further than 2019, but even if you go back all the way to 2015, it was pretty consistent, around 60% of after repair value.
Mm-hmm.
Then we saw it go way up during the pandemic. People got a little crazy about what they were willing to pay on our platform. Even for these distressed properties, it went up to over, close to 70%, over 65%. of the after repair value, which may not seem like a lot, but that's, that can make a big difference, especially at an aggregate level. But then we saw when mortgage rates started going up in 2022, we saw that number fall pretty dramatically, all the way down to 50%, 52% at the bottom at the end of 2022.
Yeah.
And then it's kind of rebounded and done a little bit of sawtooth pattern here, but I put the blue line in there because that's home price appreciation from the National Association of Realtors, and we see a lot of times especially in recent years, this bidding behavior is foreshadowing what's going to happen in the retail market. So we saw our bidding, this price to value ratio bottom out in November 2022. We saw home prices, at least according to the NAR, go down 3% about 6 months later. And then we're seeing rebounding demand. But all this to lead to, as the latest data I have on this is from March, at least on this graph, and it's continued, I can tell you in April, is that our buyers are becoming gradually more confident, at least based on what they're willing to pay relative to after repair value. And so we're seeing them pretty confident. And then another view on this is just the pricing by metro, which is the same metric, but it's looking at the year over year change in pricing in this price to value ratio. And along with the size of the bubble being the volume relative to pre-pandemic levels. So the red is where actually we're seeing some pricing risk, where our buyers are saying there's something in this market that tells us we should be paying less relative to after repair value. Whereas the green is our buyers are willing to pay more than they were a year ago relative to after repair value. So I think it's interesting. I mean, you do see a pretty good mix there. A lot of red down on the Gulf Coast, which is interesting. And then that one red dot, I think, is in Florida, is Cape Coral. Yeah. Some risk there that our buyers are seeing. But I think it's pretty interesting. What does this spark in you in terms of the markets that you're looking at or most interested right now?
So the markets I generally am most interested in are, I do love Indiana and Ohio. I do quite a bit in Florida, Texas. We've done a bit recently here in Alabama, Mississippi, Louisiana. I do some in Wyoming here, there too, and in Pennsylvania, of course, and Michigan. We've done a lot in Michigan. But I could see, it's funny where you got those red dots. Part of that could be we're getting towards hurricane season too, and Gulf of Mexico, right? That could be a factor too for some people. All right, let's pull back a little bit. It's just like when I'm looking at properties in, say, October, November that I'm going to be buying, I pull away from the very north areas a lot just because of the amount of snow. And in the past, I've run into issues where I'm holding a property a lot longer because big storms impede people from going to see homes. So sometimes I'll stay away from that seasonally. That's like a seasonal thing that you see just like with any real estate pattern, I think. No, but it's interesting. Like some parts of Florida look great, right? Some parts of Florida not so good. Some parts of Texas look good. Some parts don't look good there. You got it. Very interesting. That map is very telling at just how.
Yeah, there's not necessarily a super clear pattern to me. The cluster of red there in the Gulf Coast is the thing that stands out the most. And that may be related to risk of some of that insurance / hurricane risk that you were talking about. But I mean, overall, the national numbers are showing that our buyers are getting a little bit more confident. Again, the way I interpret that is the mortgage rates now have been kind of high but steady for long enough that they're kind of regaining certainty that this is what the market is. And so they can kind of count on it being this way for the foreseeable future.
The new normal, right? And once you acclimate and get used to that, and you can base, all right, we got a frame of reference now, we can look at this going forward. Sure. Yeah, no, it makes a ton of sense. Do we make it through your whole deck? Because if not, I want to bring you back and we'll get through it. So.
Yeah, we're done.
Beautiful. Yeah. But I definitely want to bring you on again here in not too distant future to see how things are looking maybe going, what are we at the end of, we're getting towards the end of Q2, going in the last month and a half here, Q2. And then we'll start looking at what things are looking like towards the end of the year, if you're game for that.
Yeah, absolutely. I think there is a lot of policy regulation that could change. I don't think it'll change super dramatically, but with the election, could shift. Depending on how the election goes, could shift a little bit with a change in administration in terms of some of the regulation that is holding back some of the foreclosures could change.
Oh, I agree. Yeah, and we'll just have to see how that all plays out. It'd be interesting. It's interesting times we're in. It's fun trying to analyze and go through all this data. I appreciate you coming on and giving the audience a lot here to look at, think about. And, this is stuff I look at all the time when I'm trying to forward think, what markets do I want to be in? Which ones do I kind of want to avoid? And that's, usually a shorter term that I'm looking at with that. And maybe it's a longer term, depending on, there's certain markets I just don't like because there's too much control. It's too hard to evict in certain markets, right? So
yeah, that's a factor for sure.
Yeah, especially New Jersey, New York, and some other different areas as well. But no, thank you so much, Daren, for coming on. Really appreciate your time.
Yeah, thanks, Paul, for having me. And yeah, if anybody wants to, a lot of this stuff that I have here is on auction.com/in the news. But that's in terms of some of this data. If you just want to look for properties, of course, you can just go to auction.com itself and start looking around.
Is there anywhere else they could follow you too? Do you have a YouTube channel?
I don't have a YouTube channel, but I'm on LinkedIn and X, I guess we call it now.
Yep.
So just Daren J. Blomquist on those platforms. So feel free to follow me there.
And Daren's got a bunch of great data. I follow him on LinkedIn. I'm going to follow you on Twitter now that I know you're on that. He puts out a lot of good data there for you guys to look at every single day. And a lot of big time investor friends of mine follow Daren. So I definitely highly recommend you guys follow him out there. All right. And we will catch you in the next episode.